Hello, everybody. My name is Sutharman Kanagarajah, and I'm a Senior Tax Manager at Cordium. So the next session is called Recruitment, Rewards, and Tax Traps. And our speakers today are John Hindley, Anne Healy-McAdam, and John Davison. John Hindley is a partner at the executive search firm Heidrick and Struggles, and he specializes in recruiting for the financial services sector. Anne is our private client tax partner, and she has over 20 years of experience dealing with non-dom tax issues and tax planning involving offshore trusts. John Davison is our head of tax. He was previously head of tax at the IMA, where he was involved in developing the reporting fund regime and also the property authorized investment fund regime. He was also head of tax at New Star Asset Management. So to kickstart our session, I'll hand you over to John Hindley.
Hello, everybody. I'm going to spend a couple of minutes just talking about the sort of strategy you could have for talent in a relatively small organization, and how to think about talent in the broader context of the business, which then leads on to tax and reward and sort of the hard facts of what Cordium do. The previous panel where we talked about cybersecurity, two things really struck me. The first was repeated reference to culture and the repeated reference to the people in the business. Those are the two planks on which you sort of defend against cybersecurity, was what I took from that. And if you think about cyber as one area of your business, then there are a number of different areas, whether it be distribution, investment management itself, operations, technology, where you should always, I think, be cognizant of the talent you have, your strengths and weaknesses, and how you would react if you lost somebody, which is incredibly relevant at this time of year, bonus season, such as it is. We see a lot more movement in the market. And so what I've done is just set out the pillars for a very basic talent strategy. It doesn't include things like graduate recruitment, doesn't focus on succession planning, which is sort of the birth and the deaths of people's careers, but really just thinks about some of the basic things that we advise our clients on at Heidrick. The first thing I'd say, and this really segues nicely from cybersecurity, is to assess your needs. What's your business going to have to deal with this year? What challenges will it face? Then you've got to have a good look at your team and figure out their strengths and weaknesses. This changes over time and in the face of the challenges that are presented to your business. We've seen a huge increase of late in regulatory hires, technology hires. 2 years ago, we did a lot of work in the treasury space as the banks came under pressure for balance sheet concerns. So look at your business in that regard. There's then the need to figure out whether you can be opportunistic in your hiring. That often happens maybe in front office, the front office, or if things are imperative, you really need to get them done and in short order. And then it's a case really of looking at your bench and thinking about additions, subtractions, and substitutions. And bearing in mind that sometimes you have people who are massively overqualified for the jobs that they're doing, and you actually are not doing them a favor by keeping them in those jobs. Sometimes you need to do essentially downgrade as well as upgrade. A rolling talent strategy will then lead you to assess the strengths and weaknesses of your business against the market and where you can find good people, how your team is perceived in the market, supply and demand, what's hot in terms of where we're seeing a lot of activity, and to figure out candidates' availability. So that if you did lose, say, a head of treasury, where you'd go to find such a person, what they'd cost to replace, and how long it would take to do it. The thing I like to also remind clients about with any talent strategy is if you are meeting candidates for various roles all the time, and I do suggest that this is a good thing to do to keep your ear to the ground. Somebody in an organization should always be interviewing on a sporadic basis and keeping an ear to the ground. Try and be really honest about how you sell an organization. As a headhunter, things rarely fall over for any other reason than people not being very transparent about what the job is and the strengths and weaknesses of the firm that they're bringing on board. When I've got a particularly tough sell, so it's a role that's for a firm which has its challenges, I start with the challenges because, frankly, I find it builds credibility on my side, and it allows the candidate to engage with you on those problems and actually help solve those problems, as opposed to feel like they're being told everything's brilliant when it isn't. It's important to listen to the candidates. I've had far too many interviews myself in my life where people have just talked at me for 50 minutes, spent 10 minutes sort of talking to me, and then decided I was a great guy. That's, well, I am a great guy, but that's not the best strategy for finding out what you need to know. Remember that as well as buying, as in persuading candidates to join your organization, you're also selling, as in they need to sell themselves. And this is a really obvious point, but there's an assumption that things can be taken for read when you look at a CV or a resume. Cover the ground. Make sure you know exactly why each individual has left an organization. Figure out the pushes and the pulls. Ask them about pretty much every line on their resume, because you need that granular information to make a hire. This person's going to, if all goes well, make a decision about coming to work for your organization based on 6, maybe 10 hours of time spent with you as individuals in a hedge fund firm or sort of other buy-side organization. So you owe it to them to get into that level of detail. Where the tax department comes in tends to be with the cost and the compensation. A couple of things I would say imperative to any talent strategy. Firstly, when you're making an offer, think about what the person receiving the offer is going to see when they see those headlines. It's actually really possible to make an offer look much more compelling with a few tweaks than you would ever believe, just by putting, say, an increase on base, or in the same way that we have a $4.99, people think it's cheaper. £5 of 5 looks a lot better as well. So just think about those sorts of things. Make sure whenever you're trying to hire somebody that you ask them about their comp at least 3 times, and then get hard evidence to base that on. And also think about the full, what comp really means. So it's not just what they were paid in cash, it's what they've got in deferral, it's equity, it's benefits. If you're taking people from a bank, that's an incredibly complicated ask, because there's good and bad leaver provisions, there's vesting rights, et cetera, et cetera. Make sure you find out what the notice period is. If you need somebody to start in March, it's no good hiring somebody on a 6-month notice. You'd be amazed at how often that happens, and then all chaos, all hell breaks loose. Be aware of the amount of time you're spending on this hire. We think it's probably one of the most labor-intensive exercises within the clients that we work with. They spend a lot of time on their hires, but that's partly our fault. We make them do that so that we feel confident that they've done the right thing. There's a lot of administrative matters. Make sure people have the work permits they need. And just be aware of the potential disruption. If you bring people into an organization where they haven't got a clear mandate, where you're bringing people in who are doing the same job potentially as somebody else, you're creating a rod for your own back. So job specs and a clear strategy on the disruption of the business is also important. And the due diligence should speak for itself, but it's amazing how many people don't take references. By that I mean formal references post-interview and post-offer, but also informal references sounding things out. The other things that we do, which we think are really helpful or would be helpful for clients, for marketers, for example, we ask them to produce a case study or a business plan. So you're coming in to sell this fund. How would you sell it? Who would you take it to? What's the strategy? Who do you know at these organizations? You're saying that you can sell to wirehouses in the States. Do you really know the guys at Merrill or Morgan Stanley? Who do you think you know? So those sorts of things can be very interesting. We also suggest that people meet candidates in a social situation, as an added piece of due diligence. A lot of people interview very well, but taking them out for dinner can be a different matter altogether. And it sounds ridiculous, but we like it when people hire people that they know. From Heidrick's perspective, you would think that's a bad thing, but actually you get a much better sense of trust, and you get much better hires if it's from within that circle. And so what we can do is broaden the circle of people that you know, even if it's not for the short term, but for future future generations. So that's a really, really basic talent strategy. But I think if you're the COO of a business, CEO of a business, those are the sorts of things at the bare minimum you should probably be thinking about. You should be looking at your bench, thinking about what happens when people leave or could leave, thinking about the replacement cost, factoring that into how you compensate them at the end of the year. Not everybody should be paid sort of equally. There is supply and demand in the market, and you need to know what those factors are and how likely it is that your head trader will be picked off versus your head of sales. Do the basics well. That would be the sort of the final advice in terms of talent strategy. Now I'm going to hand over to our next speaker, really just to talk about the minutiae of that and the real sort of difficulties, because there are some things that can't be worked around easily and have to be planned for well in advance.
Thank you, John. And so John's spoken about recruiting talent. So when there's talent, there's profits, there's money involved. And when there's money, there's, of course, the taxman. So Anne is going to talk to us about the various issues facing individuals, especially on the non-dom tax side. But to lead us into her session, we have a polling question. Is one of the principals in your organization a non-dom? Okay, that's interesting. 55%.
Yeah.
Anne, I'll leave it to you.
Okay. Wait. I forgot to switch. Right, okay. Good afternoon, everyone. I thought that I would give you some ideas on bringing international talent, because let's face it, everyone wants to come and work and live in London. Which leads us nicely into the domicile issues, or in fact the non-domicile issues, which at the moment are a hot topic with Inland Revenue and of course the government. So what I thought I would do initially is explain what domicile is, because on TV they always get it wrong, and then give you some tips about pre-residence tax planning, tell you what changes are going to happen, what proposals we're going to make, and if you're caught with the new proposals, what you can do. So domicile, what is it? It's a concept of international law which basically determines where which jurisdiction a person is sort of within. In the UK, we use it as a way of taxing people. You might have heard of something called the remittance basis of taxation. That basically allows people who are not from the UK to be only taxed on the UK income and gains if they can claim the favourable tax status. So you have a domicile of origin. When you were born, you take the domicile of your father, which remains with you throughout your life until you displace it with a domicile of choice. To make a domicile of choice, you've got to abandon your domicile of origin and say that in your new jurisdiction where you are resident, you are going to stay there permanently. And you must essentially abandon the old domicile and say you're now in London or whatever it is you're going to be. Obviously, the tax status is so favourable, they don't want people to have it forever. So at the moment, if you have been resident in the UK for 17 out of 20 years, you become deemed domiciled, which means you can no longer claim favourable tax status and that your worldwide estate is subject to inheritance tax. So to look at how this actually affects real people, there is planning you can do if you have a new executive arriving in the UK. Preferably, you do it a few months before the tax year which they are going to arrive. And as we all know, the tax year starts on the 6th of April. Because when a person arrives, their residence status is decided by the statutory residence test, which sounds easy to ordinary people, but isn't actually anymore. Because When you arrive in the UK, the year that you arrive in could be split, which means you can be taxed on everything from the day of your arrival in the UK and everything foreign prior to the time you arrive. But it's not always that easy. If you are coming to work full-time in the UK, you are allowed to split the tax year, which means that all your foreign income that you earned before you came here falls out of tax in the UK, and that we're only interested on everything since the date of your arrival. However, if you had a home in the UK before you arrived here, i.e. before the 6th of April in the year you arrived, you are not actually allowed to have a split year, which means that everything that you earned globally is taxable in the UK from the 6th of April in the year you arrived, even you weren't here for part of it. So a little bit of tax planning can assist many people from falling foul of these regulations. Basically, someone who is born abroad, who's coming to the UK to live and take up work, they should review their assets before they come here. For example, if they are directors of foreign companies, by moving to the UK, if they are the sole director, which you find in a number of foreign jurisdictions, they will have actually moved that company to the UK, and that company will be taxable in the UK. Therefore, you've got to look at the management and control structure within any companies that they are directors of. Also, if they are a trustee of a trust, and quite often in some European jurisdictions, you have family trusts where the trustees are in fact a husband and wife. If they then come to the UK, they have just brought that whole trust into the UK tax net. Where a lot of people fall foul of this is if they are US citizens, because a lot of US citizens have living trusts where it's generally them and their wife who are the trustees, and if they come to the UK, that whole trust is now taxable here. Okay, if they're a US citizen, we can claim some credits under the double taxation agreement. However, if the assets are predominantly outside the US, we can actually tax them here. So if a person's coming here, they want to also rebase their assets, i.e. buy and sell shares to make sure that they have a current value rather than the value that they had 15 years ago when they bought them. Because if you bought shares 15 years ago and come to the UK and sell them when you're a UK resident, we'll tax you on the whole 15 years worth of gain, not just the 3 months that you've been in the UK. So what I'm essentially saying is, pre-residence planning, we should sort out your capital and income position, segregate it. We segregate it because the capital, the day you arrive in the UK, everything you actually own is capital. So if we can put that into a little pot, we can bring it into the UK tax-free. If we don't put it into a little pot, we have tainted funds, and you will spend a lot of money with an accountant actually working out what is taxable where, and you will pay a lot of tax on it. So the idea is you do this prior to the tax year in which you come, just in case you don't get split year treatment in the year you arrive. Also, you've got to be very careful that if you are a beneficiary of an offshore trust, that your trustees are not overly keen on giving you money. I had a case a couple of years ago where I had a Spanish lady moving to the UK. She had an offshore trust. The trustees thought, oh, you'll need a lot of money when you live in London, so they gave her £1 million, which was very nice for her, until she realised that when she came here, the anti-avoidance legislation that we deal with trusts means that whenever that trust makes a capital gain, for however long she lives in the UK, she's going to have to pay capital gains tax on that £1 million because there weren't gains in the trust at the time it was paid out to her, which means that she's not a happy bunny. So, where is it? Oh, so essentially, you would set up one of these structures where it's basic traffic lights. You would have your capital account, which you could bring into the UK tax-free. The income account is going to be taxable if you bring it in, which you prefer not to really. And again, your share portfolio, assuming you have one, gains will be taxable and dividends will also be taxable. So, no doubt in the press you'll have heard there's been lots of changes to the rules regarding non-domiciled individuals. The old rules basically were, if you were resident for 17 out of 20 tax years, you were deemed to be domiciled here, but only for inheritance tax purposes. Now, it is at any time in the tax year, so you could actually just be present here for 17 years and 2 days and still actually be subject to inheritance tax on your worldwide estate. The new rules that are coming in from 6th of April 2017 are going to change it so that it's 15 years out of a 20-year period, and it's for all taxes. So after 6th of April 2017, you're going to be subject to capital gains tax on your worldwide income and gains and income tax, whereas at the moment, we ignore the capital gains tax and income tax. You lose a remittance basis of taxation once you become deemed domiciled, which means that you will be taxed here. There are other proposed changes that were brought about basically because I think it was the chairman of one of the large banks went in front of a select committee and upset a number of people because he had a very broad Scottish accent and he claimed to be domiciled in Hong Kong because he had lived there a long time. So now they're proposing that the place of birth is now important, which is a bit of an anomaly because we've never used that as a test for tax before, and is actually quite unfair. This is actually under consultation with HMRC at the moment. They had a consultative document that was open until November, and I understand that we are expecting something to come out in March as to what they're going to do. But basically, these nasty new rules, if they actually apply, if someone like our Scottish chap had lived in Hong Kong for 20 years, if he comes back to the UK, he's going to be automatically deemed domicile from the beginning of the tax year in which he arrives, which means that we will tax all the wealth that he's created whilst he was in Hong Kong. We'll also look through any trusts that he's established while he was non-domiciled, which means that we'll get a hefty tax bill. When you leave the UK, there currently is a 3-year hangover, which means you remain domiciled here even if you decide to emigrate to Australia. I had a client many years ago who emigrated to Australia and died 1.5 years later because the double taxation agreement between ourselves and Australia says that we have this 3-year hangover. This chap's estate fell wholly taxable, subject to inheritance tax in the UK, even though he'd been away for 1.5 years. His family were not happy because there is no IHT, well, there was no IHT anyway in Australia at that time. Under the new proposed changes, they're going to say that that hangover year is 6 years rather than 3, which I think is a bit harsh. So, if you have been resident in the UK for, say, 13 years, 14 years, you really should undertake some planning before you become deemed domiciled. At the moment, as I said, it's for IHT, but if the changes go through, it's going to be for everything. So the first point you've got to think of is, can you count up to 15 or 17? That people will think is a vacuous question. However, I dealt with a case last year where a firm of lawyers got it wrong and couldn't add up to 17 and set up someone an offshore trust, which meant he had to pay lots of tax because they got it wrong. So what you should do if you're currently a UK resident is you should uplift the base cost of your non-UK assets, i.e. everything outside the UK, by selling them, not to a spouse because that doesn't work, because sales to spouse are at nil gain, no loss. You've got to remember if you're selling shares that there's got to be a 30-day gap between purchase and sale because of the old bed and breakfasting rules. So an easy way to uplift the base cost is making a gift to an offshore trust. However, you've got to be very careful that you aren't actually domiciled at the time that you do this. You haven't decided that you've sold all your assets everywhere else, well, your houses elsewhere, and that you want to live here forever, because then you'll be subject to inheritance tax and capital gains tax. So what else should you do? If you've got private companies offshore, you should accelerate income, get it paid now, because if it's retained offshore, if you're on the remittance basis, it's not taxable unless you bring it to the UK. You could consider distributions from an offshore trust, providing you actually have capital gains in that trust, because like my little Spanish lady, if you don't, you will end up paying tax forever, really, until the gains are met. You could think to establish an offshore trust. That is only effective for inheritance tax, but that basically means that your foreign assets will stay out of the UK when you die. Again, why would you have an offshore trust? It protects your family wealth outside the UK. It gives you control of who gets what, essentially, when you die and, well, after your death, really. It's excluded from inheritance tax because you don't have to pay inheritance tax on it if it's foreign assets. If it's UK assets, all you do is you transfer them to an offshore company that is then held by the offshore trust, and it moves assets out of the inheritance tax net in the UK. But there are capital gains tax issues that you need to look at. And you've got to be very conscious of settler issues when you set up an offshore trust, because you can be liable to income tax and you will be liable to capital gains tax, but there is a method of deferral. I hope it's not been too technical. It's very, well, I find it very interesting, but not a lot of other people do. I apologise. But that's just thoughts for what's happening. Next time you watch the news and they moan about domicile, you can tell them they've got it wrong, because they generally do. Over to John.
Okay, so Anne's talked about the taxation of non-doms. Now, that's specific to individuals. Over the years, there's actually been some changes to the way in which fund managers are taxed. So 2 years ago, we had what was called the salary partner rules and the mixed membership rules. But more recently, and this is what John's going to be talking about, the UK government has brought in a set of rules called the disguised investment management fee rules, and also changes to the way in which carried interest is taxed. So this affects all fund managers, and it's incredibly important. So we'll go on to a polling question, which will then lead on nicely to what John is going to talk about. So do you use offshore remuneration structures in your business? Okay, that's interesting. So I'll let John comment on that. Over to you, John.
Okay. Okay, thanks, Sutha. Well, you've spoiled the surprise bit and told everyone what the presentation's about, and I know I'm the last speaker in the last session, so you're willing me to be quick, and I'll try to be brisk. What I'm going to talk about, I'll talk about disguised investment management fees and carried interest. But first of all, I just want to talk about the kind of mental mindset of the participants. So, what does the taxpayer think, and what does the tax authority think? First of all, if you're the taxpayer, what do you like? Well, best of all, pay no tax at all. If you do have to pay tax, then it's nice to pay it later, maybe some sort of equity-related remuneration, or pay it at a lower rate. So put it outside the UK, or to pay at a lower rate, or perhaps within the UK, pay capital gains tax instead of income tax. So that they're the sort of things the taxpayer wants to achieve, and not such nice things as when the tax authority sort of counters that, perhaps converts what you thought was capital gains into income tax, for example. From HMRC's point of view, their framework is that if you're in the UK and you're making a profit from carrying out investment management activities here, then they want to tax that economic profit. But, as we've seen in Anne's session, they still accept that essentially if you're of non-UK origin, then it's still possible to keep certain sort of non-UK income and capital gains outside the UK tax net. And last of all, it's probably quite important to remember that there's nothing to be ashamed of if you've got a non-taxable fund. So there's nothing that the HMRC find inherently offensive about the fact that the fund itself is not taxable. The idea is the level of tax in the fund should be at the investor level, not in the fund. Okay, so moving on, let's just sort of talk about a practical example of how some entrepreneurial fund managers might set themselves up. So there's some guys here who are, well, first of all, the fund managers are on the left. That's the little group of people up at the top. They set up an offshore fund. That's located somewhere outside the UK where there's not a lot of tax. They probably set up a local operating company, and then they set up a UK company, which they conduct their activities here in the UK. The fund has investors who could be from anywhere. The investments could be anywhere. And in addition, the owner-managers may have an interest in the fund. So that's how they set up. So just sort of looking at this setup, where does the tax occur, bearing in mind what we said about HMRC's mental sort of their mindset? Well, you're going to be making profits from managing the fund. Some of it's going to be in the UK, some of it could be offshore. And essentially, the first layer of tax is in the vehicle itself. So the green company or the blue company will make profits, and there'll be some level of tax there. And then when the profits are extracted to the owner-managers, then there's a second layer of tax there. They may also draw a remuneration out of the companies as well. So that's where the profits are going to be taxed. Now, just sort of thinking about this, if they want to pay less tax, what do? Well, the obvious thing is just bung all the profits in the blue box and have no profits in the green box. So, do you think we can do that? Is it as easy as that? Well, not really, because even outside the investment management space, just in the normal rules of international tax, you can't simply recognize profits in a low tax regime and add the value in a high tax regime. So if all the activity, all the value add is going on in London, then you're booking all the profits in the local fund manager, then the first thing HMRC could do is say that actually you've got a UK permanent establishment, and that means that effectively the non-UK company has got a branch in the UK. So a permanent establishment is the thing Google doesn't have. It's like having another company effectively. If one company outside the UK has a permanent establishment in the UK, it's as good as having a subsidiary that's making profits here. So I think permanent establishment is the easiest way for them to deal with this. But also, even if they don't go for that, then they could just make a transfer pricing adjustment. So you basically impute revenue from the blue to the green, and you increase the profits. So even if your accounts say low, for tax purposes, the profits could be high. So they have existing mechanisms already to correct any abuses like this. However, not content with that, they perceived that there were certain specific abuses within the asset management industry, so they came up with some bespoke anti-avoidance, especially for the asset management industry. So the first one, as I've already mentioned, is the disguised investment management fee regime, and that came in from the beginning of the tax year that we're currently in, so back in 6th of April 2015. And then they also reformed the taxation of carried interest. And there are actually two changes, one of which took effect from July last year, and then another one is going to come in a couple of months in April. So if you're using these techniques, if you have sort of offshore companies or use carried interest, it's pretty important to be aware of these changes. The first one's disguised investment management fee regime. So what does this seek to do? What they're trying to do is catch any income which is currently untaxed. And essentially, if you do have untaxed income, then this will be brought into tax as UK trading profits. So this is essentially the highest rate of tax. It's income tax plus national insurance, and there is no higher UK rate. Untaxed is quite narrowly defined, and amounts that you get from existing arrangements are not excluded by any sort of grandfathering type regime. So if you've got old arrangements and they're paying new amounts, then they're going to be caught. So just to quickly canter through the conditions for disguised investment management fees to arise. Firstly, there's got to be investment management services, and it's pretty widely defined, so it's not just asset management. It could be sort of raising funds or fund administration, that kind of thing. It's pretty broad. It has to be connected with a collective investment scheme, so they've taken the definition straight from FSMA, Section 235, and then added on UK investment trust companies. I'm not quite sure why that was required, but essentially it's a straightforward collective investment scheme. And the fee is untaxed, where it's not already charged to either employment income tax or trading profits tax. So even if there's been capital gains tax, or you've paid tax in some form of dividend tax, that'll still technically be untaxed for the purposes of this regime. Other aspects to be aware of: the regime imputes deemed trade. So if you're a UK resident, then the duties are carried out wholly in the UK under this deeming, and the remittance basis doesn't apply. So if you're a non-dom and you were thinking you were doing things overseas, if they're caught by this, then it's that income's coming back and coming into the UK tax net. It's even possible to be non-resident and be caught if you're carrying out the activities in the UK, but you'd have to be doing that via a permanent establishment, so the sort of thing we mentioned before. Exclusions, sums which are carried interest, we'll come to that in a minute. Repayment of capital where you've invested in the fund, return on capital invested if this is in line with what the other investors have got, and fees already charged to tax either as income, employment income or trading profits. So effectively stuff that's already taxed properly at the full rate of tax. Now coming on to carried interest, we'll just go back to our diagram again. Now, what is carried interest? I was just taking a drink rather than posing a question. I'll just explain. As I'm sure a lot of you are aware, the carried interest is a form of remuneration for an investment manager where the fund manager gets an interest in the fund and hitting certain thresholds. And historically, people have liked this because you've been able to get a sort of base cost uplift due to sort of existing provisions that apply to normal trading partnerships. And it's also good because it's taxed at capital gains rates, and also if it's non-UK assets, you can sort of not remit them into the UK. So it's a kind of quite a nice, attractive means of remunerating somebody historically. So what's changed? Well, first change. This one came in last year, and this took away the base cost shift. So basically, if you are receiving carried interest now, then you'll be taxed on the full amount of the profit, and you won't get any deduction for somebody else's base cost, basically. At the same time this came in, there was a change which effectively deems any offshore gains to be UK gains if they're derived from UK activities. So it was a sort of double whammy, really. And the objective of HMRC, they stated at the time, was to tax the full economic gain arising to an individual from UK investment management activity. It doesn't affect you. If this is just investing in the fund alongside the investors, then that's unaffected. It's just where it's remuneration. Second change, which has come in, this followed some consultation which ran up to, I think it was from September up to December. And what they've done now is if you have carried interest in a fund and the underlying asset portfolio is churning pretty quickly, then that will be taxed as income. So if the fund portfolio turns over with a less than 3-year holding period, and the fund manager is receiving carried interest from this, then it will be taxed fully as income. If it's conversely, if it's held for more than 4 years, then it can still be capital gains, and then there's a sort of sliding, tapering amount between 3 and 4 years. So where income tax treatment applies, again, it's UK source trading income. So if you're a non-dom, then you're further constrained in making use of the remittance basis. So in summary, past planning structures may no longer work and they should be reviewed. Again, just to remind myself, there's no objection to tax-exempt funds, but the tax environment has become a lot more challenging, and HMRC want to tax full profits generated from activities which are going on here in the UK, and it's entirely consistent with the international sort of mood music. So you've got the US introducing FATCA, you've got the OECD's base erosion and profit shifting project, information sharing agreements with HMRC and other tax authorities, but they mean for it to get a bit tougher. So that's where we are, really. That's me. Hand back over. Cheers.
Okay, so before we close, there's just a few questions. And the first question is for you, John Hindley. What are the 3 worst hiring mistakes you are aware of, and what for each could have been done at the outset, or what was missed which could have avoided the mistake?
Sure. There are a lot of hiring mistakes. I think the 3 probably most common, lack of disclosure of the full facts about the business going in, so people just being missold. That's probably the worst from the candidate's perspective. Closely aligned to that is the job spec not really matching the reality of the role. that's a really difficult situation. Arriving to think you're going to do one thing and doing something else completely. And then from the hirer's perspective, I think not taking up proper references and not doing the proper background on people. A lot of referencing is cursory rather than really detailed, and so I think that's probably the third and most common mistake from the buyer's side, if that makes sense.
Okay, and there's a question for you, Anne. If I was born in the UK to foreign parents, am I automatically UK domiciled?
No. In fact, I would say you're probably automatically not domiciled, because when you're born, you take the domicile of your father at the time of your birth. Although under the new rules, they will look at the place of your birth if it goes through the proposed changes. But that's what we're in consultation about at the moment. But as it stands at the moment, no, I would say you're probably non-dom.
Okay, and that leads us on to another question. Is it possible to go abroad for a couple of years to stop becoming deemed domiciled?
Yes, it is. 5 years is normally what you would need to break the count. And also, but if you do that, you've got to remember that we also have anti-avoidance legislation that says if you go abroad for less than 5 years, we will seek to tax any gains that you've made in the intervening time whilst abroad when you come back. So yes, you can go for 5 years, but don't sell all your assets when you're away, because that used to be the old tax avoidance trick about 10 or 15 years ago, and they didn't like that.
So that's if you go away for more than 5 years, it's fine?
Yes, you come back and the clock starts again.
Okay, good. There are a few more questions, but I think some of these questions might be worth speaking to directly. A lot of these questions are non-dom questions.
Okay.
So it may be worth
With a
speaking
glass
to
of
Anne
wine, I'm
directly
quite
afterwards.
happy, yes.
I suggest for now we close the session. Just a reminder, on the app there is a feedback form, so please could you fill that in, and please join us for drinks. Thank you.
Okay.